Good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, we are entering the pleasant chilly weather, and it so seems that the financial markets are also, as no major events are lined up for this week. And even if there's no major event, we've had a quite interesting set of data points which were seen. FPI is clocking in significant monthly flows after quite a while the reserves rose at the fastest pace in more than a year. Now, there's also a lot of discussions on the possible or the likely slowdown as is also being observed, but it was all in the effort of taming the also notorious animal in the name of inflation. So, JK, what's your thought? I mean, what's going on? We are definitely seeing signs, and the central banks preparing for the possible slowdown. But is there any other things that we should be watching out for? And what's your thought?
Yeah, good morning. Yeah, the euphoria in the markets post CPI data has definitely died down, and all the segments of the markets are having some sort of a reality check, including yields, stocks, and currencies. Though we haven't seen much retracement, but definitely they seem to have found a level of resistance, uh, bond prices as well as the currencies. Stocks have also been drifting, but not lost much. Uh, what's been happening is a plethora of speakers from the Fed. They have lost no time in conveying to the markets that the Fed's job is far from done, and there have been varying degrees of hawkishness from them. Following the extremely hawkish bullard last week, the Boston leader Susan Collins said that little evidence price pressures were waning, and the Fed may need to deliver even a 75 basis point hike as it seeks to get inflation under control when they meet in December. At the same time, Atlanta Fed President for Boston said a slower pace of rate hikes with the terminal rate not beyond 5%. Definitely, it is contrasting with what Bullard said last week. In the meantime, market sees recession certainty next year as the yield spread between the 2 and 10 year is now at 71 basis points, an inversion of curve that has not been seen into such depths since 2000. Despite these hawkish comments, we haven't seen much losses for equity markets, but definitely a slow correction. Even as we also observe some reports indicating highest level of inflows into equity funds, that was seen compared to the last 35 weeks. And as investor optimism has brightened. Notwithstanding the meltdown in crypto assets, the treasury yields have moved up, but only recovering slight of the what losses they were seen after the CPI data. Currencies have been late to catch up on the corrective side, mostly due to slowly emerging positive economic data from Europe and UK. Euro in particular was supported due to hawkish comments from Lagarde once again, while reportedly ECB is mopping up excess liquidity through the repayment money of banks from the LTRO scheme. So this is apart from the fact that we have seen a series of data from Europe, which is been a surprise to the upside. But what we need to see is whether it continues in the coming months, because there could be some temporary factors at play as well. Even UK has seen a series of strong numbers, and the last number to see such improvement was retail sales for October, which showed an increase of 0.6%, well above the market consensus. And again, there is a sense that we need to see whether higher inflation could keep the consumer so interested in the coming months. Some people are expecting a subdued Christmas sales period as well. At the same time, inflation in UK is at 11.1%. BO is on course to raise rates further at least 0.5% when they meet next. But the investor confidence definitely is high on UK after the autumn statement by Jeremy Hunt last week, and that has kept the sterling, somewhat supported, because overall for several years now, UK pound is shorted by long-term investors, and structural shorts may be getting unwound in a gradual way. The 40-year high inflation in Japan again does not seem to have evoked any sort of a policy response. Unlikely, because Kurra still says that it does not warrant a change in the monetary policy, but they seem to be addressing the imported inflation by intervening in a stealth manner in USDJPY and keeping it in a lower range now. And if we do see further dovish developments in the US monetary policy or a lower inflation number, I think USD yen may have an attack at 138 on the downside, definitely capped at 142 for the time being. But what is concerning probably for the market has been two things. One is further rise in COVID cases in China. Now, with Beijing is also facing a lot of restrictions, and some other cities going for full lockdown as well. And that has seen the yuan cross 7.17 in today's morning trade. And that's quite a up move for the dollar from the 2.02 levels seen after the last announcement, as well as on the CPI, CPI coming down in the US. Another important development in China has been the bond market slump there, as the prices declined after government took steps to boost the economy, have prompted investor outcry and a rush of redemptions, putting pressure on asset managers, to restore confidence in their fixed income products. Earlier in the year, investors had rushed to the safety of bonds as the economy was slumping, and they had been caught off guard when bond market stumbled this month when government eased some of its COVID-19 measures. And China, we have known that in the last several months, there were huge outflows, and that had seen the Chinese yuan drop by more than 10% this year. So now this might be actually happening again, because bond market is definitely seeing a slump there. So multiple problems for China still continues, and that is telling upon the commodity-based currencies like Australian dollar and Canadian dollar as well. Oil prices have slumped below 87 in Friday's trading, and technically look there can be more losses, even as the traders consider the possibility of overall global growth slowdown, particularly in 2023. And has it helped rupee? Definitely not, because while the rupee was on a weakening phase, oil was always playing a factor in it. But when the oil is actually coming down, that has not helped the rupee. That is the uniqueness of rupee, because it's structurally having a deficit issue, which is not only led by oil, but also a rise in other imports, as well as global growth concerns affecting the exports as well. So rupee again looking to trade near 81.80, a big recovery for the dollar after the drop from 83.25 to 80.50. And if a dollar index corrects further upside, test towards 82 is not ruled out for the USD. So we are starting the week on a very subdued note overall, and this is also a short week for the US, because we have the Thanksgiving holiday on 24th. So next week will be a bigger eventful week, because we'll have the core PCE inflation, which the market is looking forward to very eagerly, as well as the non-farm payroll data, which will be published this week. We will only have the GDP data, rather not this week, it's also coming next week. So GDP data also will be coming on the 30th of this month. Yeah, that's it. Thank you.
Okay, JK, that was quite good. And yes, we are having a subdued week as well as a shortened week, but still there is a lot of things that we can watch out for. As DK mentioned, in case of dollar rupee or USD the structural deficit for India continues to keep on the inherent demand for dollars in the economy. And uh, on the Japanese central bank side, we've been seeing there has been a continued stealth intervention by the Japanese central bank to manage the imported inflation that they have been facing for the quite a while. On the other hand, investor confidence was seemed to be quite high for UK, which has prevented some bit of excessive selling for the pound. But folks, one of the major concerns has been the inversion of the yield curve, which has been at 71 basis points, which is uh, the last seen level of 2000, not even 2008. It was last seen in 2000. So that's quite interesting to watch out, and it has kept all the central banks on their toes with the fact that they are expecting some sort of a slowdown in the economies across. So that's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.